Stocks fell on Wall Street as investors confronted an uncomfortable possibility: the Federal Reserve might raise interest rates before the year is out. That is a sharp shift from where market expectations had been sitting. For months, most traders were pricing in steady rates or even cuts. Now some are reconsidering whether the Fed's next move could actually be a hike. That reversal in thinking was enough to send equities lower across the board. Here is why that matters. When the Federal Reserve raises its benchmark interest rate, borrowing gets more expensive. For businesses taking out loans, for consumers carrying debt, for anyone who needs credit to grow. Higher borrowing costs tend to slow spending and investment. That squeezes corporate profits. And when profits come under pressure, stock prices usually follow. There is a second channel as well. Higher rates make bonds more attractive. When yields rise, some investors shift money out of stocks and into fixed income, which adds another layer of selling pressure to equities. So what is driving the concern? Recent economic data has been sending mixed signals. Inflation is still running above the Fed's 2% target. Parts of the labor market have stayed firm. Together, those conditions give the central bank little room, and possibly less reason, to ease policy. If price pressures pick back up, officials could find themselves in a position where holding rates is not enough. Fed officials have said consistently that they are watching the data before making any decisions. The central bank has held its policy rate steady after a long series of hikes that started in 2022. The assumption in markets had been that the next move would be a cut. A move in the opposite direction, a hike, would represent a significant policy reversal and catch a lot of investors off guard. Bond markets reflected the unease. When rate hike concerns build, investors typically demand higher yields on government bonds to compensate for the added risk. Those higher yields, in turn, drag on stock valuations, especially for growth companies whose future earnings look less valuable when you discount them at a higher rate. With no major Fed policy meeting immediately on the calendar, traders are left doing what they often do in uncertain stretches, passing public remarks from Fed officials and waiting on the next round of economic data. Upcoming inflation and jobs reports will carry extra weight. Strong numbers on either front could push the rate hike conversation further into the mainstream. The practical takeaway: pay close attention to the next inflation and jobs releases. Right now, those two data points are the clearest guide to where Fed policy, and by extension markets, may be headed. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.